we are taking up on to chapter number 7 on mutual funds. See, after seeing the first unit on to introduction and why to invest and all that, now a stage has come where we have got to solve certain problems with the background of what is mutual fund, how it works. When we start solving the problem, then some more theory also we do have. So this topic is like that. Problem areas are a little separate, theory areas would be a little separate. So you don't find them gelling together. See, this topic is like a cinema where you find comedy track is running separately with that of the mainstream. So I would consider that problem solving is the main track. The theory is like a comedy track. So therefore, the link between the two will be a little less when compared to the other topics. Now let's just go through the very first problem, and some of the concepts also we will be knowing it better only when we start solving the problem, because if you just take up theory for discussion firstly and then take up problem, so you will be finding the link will be a little less. Now let us just try this question number 1. You can earn a return of 15% by investing in equity shares on your own. You are considering a recently announced equity mutual fund scheme where the initial issue expenses are 5% and the recurring annual expenses are expected to be 2%. How much would the initial, that is mutual fund scheme, earn to provide a return of 15% to you? Before we could solve the problem, let me tell you that whenever there is an advertisement coming up on mutual funds in television, you would be finding the advertisement will be run very fast. So investment in mutual fund is subject to market risk, read carefully, offer documents before investing. This is the speed at which they should tell, but they will increase the speed and the audience will not know exactly what exactly they are trying to convey. So what they are telling is that investing in stock markets is subject to risk, and one cannot be expecting what is promised. So there is a shortfall in the earning and there may be some disappointments there, and they have said this way disappointment will be there, so please be careful. It is a sort of an statutory warning given in a cigar, statutory warning, smoking is injurious to health, like they have just given that as a very important or a statutory warning before investment is made. Why should I refer that to this particular problem? There is a lot of link between that advertisement to this problem. So it is something like this way. We have something called as entry load, exit load and all that. So this entry load and exit load theory we will be having a discussion separately, problem solving in which I am using it separately. What is an entry load? See, this mutual fund is operating both in primary market as well as in secondary market. What do you mean by primary market and secondary market? Money will flow from investor to mutual funds, and the transaction is carried out with a stock exchange, that is securities exchange, through brokers. So what happens when you have so much of money to be collected and to be remitted? Definitely there will be lot of flotation cost, I mean lot of brokerage and other expenses that will always be there. By the time it reaches the table of portfolio manager, say in the process of money deposited by the investor till it reaches portfolio manager, some 6-7 rupees will be lost towards cost. This is what they deduct and call this as entry load. Now you find the portfolio manager having got that 94 rupees in his hands, he will be investing. He will not know the history. What history he will not be knowing? How much the investor had invested, how much in the way it got lost towards entry load. He will know that 94 rupees as his money available for investment. So imagine that he is bringing out a return. What is a return? So he would say he is getting 14.89% as a return. He is bringing out an announcement. He had made an investment where it is fetching 14.89%. So people normally don't put it out as 14.89 and all that. People say 15%. If I were to score in one examination a 69.25 in one of this examination, very recently qualified. So my brother was just saying, my brother had just got 70 marks. Say that rounding off will always be there in any human system. Even when it is C to C, cost to the company, when it is 7.85, people round it off as 8. When it is 9.92, people tell us 10 lakhs. When it is 25.67, people put it out as 26 lakhs. So this 14.89 can even be conveyed as 15%. Okay. So 15% when it is reported, what the investor will start dreaming, okay, I have put 100 rupees, I will be getting 15 rupees back is what he will be expecting. Actually, it is not going to be that. So on what basis he got that 14.89? So the portfolio manager got 14 rupees return. Take your calculator and cross verify. So 14 rupees he got divided by 94. 14.89 is what you have. This is what he would have rounded it off to 15%. So what the portfolio manager conveyed as 14 divided by 94 as 15% is correct. Nothing wrong into it. What the investor expecting 15 rupees as the return is also correct. But finally, when the money is getting distributed, definitely the mutual fund will be deducting towards AMC charges, asset maintenance companies charges. So expenses are to be shared. Let us assume that it is 3% is going. So that means in 14.89, 3% you deduct straight upfront. So 11.89 is what you find available for distribution. So look at the expectation of the investor who is keeping his eyes on 15%. When you provide him as 11.89%, then he will immediately consider that investment made in mutual fund is not correct, and he may consider that 11 rupees and 89 paisa as a big disappointment, and he will be talking ill of mutual funds, saying that these people announced 15%, whereas when they have distributed it was only 11.89. He may not be knowing as on what basis the portfolio manager reported 15%, and he may not be knowing this exit load and all that, because the average knowledge of investors across the board, across the country may be on the lower side. So when this sort of disappointment is spread amongst the investors, it may be acting as detrimental to the mutual fund and for the entire scheme. So when it is detrimental to mutual funds, then the next investment may not be coming at all. So therefore, in order to protect the mutual funds from this sort of campaigning by investors, so mutual fund itself is making this announcement saying that you got to be very careful, read the offer documents carefully. So please just understand, if your expectation is so much, what should be the expectation, what should be the earnings of the mutual funds? That is, a comparison is what we will be making. What is that? What should be mutual fund when it is earning, and what is your matching return? So here we will be comparing mutual fund return and our expectation, and as well as the annual expenses. Now we will be solving that in Windows Journal. Let us know about the link between our expectation as an investor and the return the mutual fund should be providing. So the mutual fund return is expected to be greater, and our expectation is to be taken up on the lower side because of the fact that you have entry load as well as exit load. So the mutual fund manager bringing out an announcement is before taking into consideration the exit load. He would be computing the return on the money that is given to him for investment, whereas the money given as investment by unit holder will be much greater than what is available in the hands of the portfolio manager. So all these will be integrated and will be taken care of in this formula. Mutual fund return MFR is equal to your expectation as a unit holder divided by 100 minus issue expenses, also in percentage terms, plus annual expenses in decimals. Why in decimal is that when you take up the first one in fraction, that will always be expressed in decimal. So therefore, on the same analogy, when you are adding up towards annual expenses, that should also be in decimals alone. Now let us just take up in this problem. So you can earn 15% on your own, and issue expenses being 5 and annual expenses being 2. Now let us just take up that. So your expectation is 15. 15 divided by 100 minus 5 plus 0.02. So now we are trying to balance as what percentages these entities, when they are expressing as percentage, what it really means. 15 divided by 95 plus 0.02. So mutual fund return is 17.79%. Let us understand a very important thing. One and only when your expectation is 15%, mutual fund should report 17.79%. If mutual fund is announcing 17.79, in your hands what you would be getting is 15. That is what you have to understand in between. That is, we take into consideration both this entry load as well as exit load. So when you are taking up this sort of understanding you have got to bring about. Now let us just take up question number 2. So this question is also on the same lines as that of question number 1, but this problem is unique. How come it could be unique? So mutual fund return is also given, your expectation, that is investor's expectation, is also given, initial expenses are also given. The only one item that they have not given is annual expenses in decimals. So that is the only item that we have got to find out. So that becomes that finding is going to be the solution for this problem. Now let us just see as how the problem can be solved. Solution to question number 2. Now let us just read the input clearly. You can earn a return of 14% by investing in equity shares on your own. You are considering a recently announced equity mutual fund scheme where the initial issue expenses are 6%. You believe that mutual fund scheme will earn 16.5%. At what recurring expenses in percentage terms will you be indifferent between investing through mutual funds? Now let us just work out this problem. So on both sides we will make it out. MFR is equal to your expectation divided by 100 minus initial expenses plus annual expenses in decimal. So your mutual fund return 16.5, which I will put it out as 0.165, which is equal to your expectation 14 divided by 100 minus 6 plus annual expenses, which is not known, Now let us just take up this. It is 14 divided by 94. So 0.165 minus 0.1489 equal to annual expenses. So annual expenses is equal to .165 minus 0.1489. That should give you 1.61 percentage. Annual expenses in terms of percentage would be 1.61 percentage. See, sometimes in the institute they may not be giving you a direct question. This sort of indirect question is also a possibility. So the reverse working will always be having a lot of interest for the examiners. So not only the forward motion problems are important, the reverse, I mean the backward motion problems are also very, very important. The reverse working is also drawing a lot of attention. So mark that way as very important, not a very difficult problem, but that way it is very important. Now let us just proceed to question number 3. A has invested in 3 mutual fund schemes as per details below. Name of the scheme: MFA, MFB, MFC. Date of investment being 11/18, 11/19, 13/19. Amount of investment being 50,000, 1 lakh and 50,000. Entry date NAV. NAV stands for net asset value. 10.5, 10 and 10. Closing date NAV 31/3/19, 10.40, 10.10 and that is 10.10 and 9.8. Dividend received till 31st of March 19 being 950, 1,500 and nil. What is the requirement of the question? What is the effective yield per annum in respect of each of the 3 schemes up to 31st of March 2019? So let us just basically understand that yield is nothing but a rate of return from the holder's point of view. The income that is divided by investment is what we call it out as yield. I have invested so much in this particular property, how much is that return that I am getting? Return divided by investment is nothing but yield. That is what we call it out as return on investment. That is what we call it out as return on capital employed. So this income and the investment we normally take up on a comparison, or we compare this only on per annum basis. But you can't have investors waiting till 1 year for investments and all that. They keep the money only for 3 months, 4 months, and the money they will be taking it out. So reason as why it is like that. Say for example, a person would have got his savings. He would be in search for purchase of a land. He is not getting the land. Until he is getting the land, the money he would be keeping it in mutual funds. He would have spotted the property that he wanted to buy. By the time he wants to buy, he will liquidate the investment. He can't be waiting until 12 months to find out yield in percentage terms. So the investment horizon may be from the shortest period of say 1 week to 5 years also. But we can't be just telling the answer for 7 days to 60 months. We can't do like that. So 60 months we can't be just doing like that. So everything should have a common way of expression. What is the common way of expression? Annualized yield is going to be the common expression. So for example, a person who had invested in mutual funds for 10 lakhs of rupees for 3 months period. So this gentleman got 30,000 rupees as return when he liquidated within 3 months period. So 30,000 rupees divided by 10 lakhs. But please understand the return is only for 3 months. So now what is that we will be doing? We will be annualizing. Had he invested this money for 12 months, how much proportionately he would have got is what we will be visualizing. So how do we work? So 30,000 divided by 10 lakhs multiplied by 12 divided by 3. So this 3 months earning, we will multiply it by 4, because in 1 year you have 4 such 3 months. 4 quarters will make 1 year. So 30,000 divided by 10 lakhs into 12 divided by n. 30,000 divided by 10 lakhs into 12 divided by n, that being 3. So you find the person had earned a return of 12%. So if you ask him whether he had got ₹1,20,000 rupees, he would say, no, I got only 30,000. So you would have got ₹120,000 rupees had you kept the money for 1 year. And that is the standard expression, is what that we normally be doing. Yield means on per annum basis only, as a standard expression we would be making, because cost of capital will also be conveyed on per annum basis. So percentage when it is given, generally your mind should be just working out that it is for per annum basis. Now let us just see as how we can solve this problem. So now let us just take up the solution to question number 3. We have just seen the input for question number 3. Now we will solve that. So not all the schemes that we given in the problem worked for 12 months. So basically let us just know about the formula and let us know how to apply it in this particular scenario. So yield in annualized percentage, which is equal to income divided by investments multiplied by 12 and then divided by n into 100. Income divided by investments into 12 divided by n into 100. So that is the formula that we are expected to use. Okay. Now let us just apply it in all the 3 investments simultaneously. So schemes are MFA, MFB and MFC. So very importantly, these investments will be made at the NAV of the previous day. Supposing I buy so many units, what is the rate at which I can buy? I can buy at the previous day's NAV. So what is the rate at which I can sell? At the previous day's NAV at which we can sell. So buying and selling will be carried out at the previous day's NAV. Initial subscription will be made only at face value only. What is NAV? NAV, net asset value, is nothing but asset minus liability divided by number of units. If it were to be a company, we will be telling it out as value per share. Here in this case we call it out as NAV. Daily they will calculate NAV. So how the NAV will be computed? So from the balance sheet we will be picking up all the assets, and all the items of assets may not be taken up at balance sheet values. So many of them will be taken up at that day's balance. Mark to market is what we call. We have just bought 1000 shares of company A at say 40 rupees. Today the value, when it is at 60, we will not take it up at 40, we will take it up at 60. Tomorrow that is going up to say 61, tomorrow it will be 1000 into 61. The day after tomorrow when it is 75, it is 1000 into 75. As how the market movements are there, and we will capture that market price and put it into the number of quantity that we have bought, and we will be arriving at the value. So this is what we call it as, we will be marking to the market and take up all the items of assets and deduct all those liabilities. What you get is net worth, and that divided by number of equity shares, in this case that divided by number of units, what you call it as net asset value. This is the way we arrive at. Now let us just find out as what is the income and what is the capital gain they make, what is the overall income and how it is to be annualized. Now let us just see. So initial investment in all these cases being 50,000, 1 lakh and 50,000. This is what they are given in the problem. Where it is given? They are given 50,000, 1 lakh and 50,000. From there only we have picked up. Then what is the initial NAV, opening NAV? Opening NAV being 10.50. Opening NAV you can call, or entry NAV also you can call. 10.5, 10 and 10. Right. Then number of units they have bought. How do we arrive at number of units? So initial investment divided by NAV should give you number of units. So it has become the practice to tell NAV with, the units with 2 decimals. So if you are just getting more than the whole number in decimals, you can read in up to 2 decimals. So it is 50,000 divided by 10.5. That should give you 4,761.90. How do you get it? 50,000, divide that by 10.50. So what you just get as number of units being 4,761.90. How did you get 50,000 divided by 10.5? Next one 10,000, next one 5,000. How is that we have got it? So initial investment divided by opening NAV. Then what is the closing NAV? Closing NAV in the first case being 10.40. Next one 10.10. 9 rupees and 80 paisa. The difference between the opening NAV and the closing NAV is going to be the gain or loss. So I bought units at 10 rupees and 50 paisa when it was at 10 rupees and 50 paisa. Now at the end of the year, by 31st of March 19, it stayed at 10 rupees and 40 paisa, resulting in 10 paisa loss per unit, 10 paisa profit per unit, and 20 paisa loss per unit. Correct? This is the way we have arrived at. So this is profit bar loss per unit. Correct? Profit bar loss per unit. What will be the overall profit or loss? Overall profit or loss is nothing but the number of units that we have bought multiplied by profit bar loss per unit. So now let us just take up that. So without the help of calculator itself, we can just get it. It is 476.19. 476.19. And in the next case, that is in the negative. Okay, there is loss. Next one, 10,000 into 10 paisa, 1,000. 5,000 into 20 paisa. So 20%, 1,000 negative. Correct? So you have profit as well as loss. But is this profit bar loss alone that we should consider? Answer to that question is in the negative. No. Now the size of the table is becoming broader. So within the screen, I am not in a position to fit. So now let us just take up the next layer here. So other income. What are the other income that we have? Other income for A is 950 and for B it is 1500 and for C it is nil. What will be the total income? Total income is nothing but profit bar loss that we have seen plus the other income. So 476.19 negative plus 940 positive. So what you get is 950 minus 476.19. What you get is 473.81 positive. And in the second case 2500 positive, and in the third case 1000 negative. Right? Then if you look into what is the time for which they want this answer, look into the question. By what time they have invested? 1/12/18 in which they have invested. They want the return by 31st of March 2019. Right? So if you count the number of months, what you get is 4. So December, January, February and March, 4 months. In the next one it is 1/1/19, 3 months. Next 1/3/19, only 1 month. Now let us just take up that 4 months, 3 months and 1 month. Now annualized yield. How do we find out the annualized yield? So it is 473.81 divided by 50,000 multiplied by 12 divided by 4 into 100. Correct? So how much it works out to? 473.81 divided by 50,000 into 12 divided by 4. So it is coming to 2.84%. 2.84% is the annualized yield in the case of first scheme. Second scheme, 2,500 divided by 1 lakh multiplied by 12 divided by 3 into 100. So 2,500 divided by 1 lakh into 400, that comes to 10% positive. Now let us just take up the last one, 1000 negative divided by 50,000 into 12 divided by 1 into 100. So 1000 divided by 50,000 into 1200. So you get 24% negative return you are getting. So this is what they have asked in this question. What is the effective yield per annum in respect of each of the 3 schemes up to 31st of March 2019. So nobody will come and remind to you that you have got to annualize. So it goes without saying that when they are asking for yield, it should always be understood as yield on per annum basis. With this, we have completed the solution for question number 3. Now let us just take up on to question number 4. A very interesting question. Mark this question as very, very important for your examination. See, not only for examination purposes, it will give you a different dimensional viewpoint on the remaining portions of mutual fund. Let's see that. We will have a good discussion and then we will start solving the problem. Say a mutual fund having 1000 units has shown its NAV of 9 rupees and 75 paisa and 10 rupees and 35 paisa at the beginning and at the end of the year respectively. The mutual fund has given 2 options: pay 85 paisa per unit as dividend and 60 paisa per unit as capital gain, or these distributions are to be reinvested at an average NAV of 9 rupees and 75 paisa per unit. What difference it would make in terms of returns available and which option is preferable? See, one thing we need to understand is that what are the 2 options that are available, and when they are asking which option is preferable, we need to know thoroughly about these 2 options, and before we could say option A is better than option B. What are the options that are available in this problem? The first option is pay 85 paisa per unit as dividend and 60 paisa as capital gain. This is one option. When they say pay, it should be understood as pay in the form of cash. So you don't have to ask a question whether it will be in the form of cash or in the form of vegetable. Say vegetable is not there. Pay means only cash. There is no other alternative that you have. So people might misunderstand in this particular case when they say 60 paisa as capital gain. Why there should be a misunderstanding? So misunderstanding is a general possibility in all places. Even Lord Rama had misunderstood. He was not in a position to identify between the 2 brothers, Vali and Sugriva. He himself got confused. So when he is confused, then where is the status of ourselves here? We will also get confused. So where is the confusion we have? So look at your opening NAV and closing NAV. Your opening NAV is 9 rupees and 75 paisa and your closing one what they are given is 10 rupees and 35 paisa. What is the difference between the two? 60 paisa. So people might take up that difference as 60 paisa with what they given in the problem as 60 paisa here. Please understand, they will not repeat. 99.99% and information is given will be given only once and they will not repeat. So in this particular case, this is different, and here they are paying capital gains. Please understand, at the introductory stage itself I told you that by investing in shares of a company, when you are holding the shares, you would be getting dividend. So after some period of time, that is when your holding period is over, you tend to sell. So sale value minus cost is definitely a profit, is what we call it out as in the case of general trader, but you are doing it with the help of share would mean the difference we call it out as capital gains. So you get one in the form of dividend, another one in the form of capital gains. So what is the basic principle of mutuality that you have? You have got to distribute as you have received. If you are receiving it in the form of vegetable, what is that I told you? Vegetables will get distributed. If you are getting it in the form of fruits, it will get distributed in the form of fruits. Same way, when you are receiving it in the form of dividend, dividend will get distributed. When you are taking it up in the form of capital gains will also be distributed. So therefore, that 85 paisa and that 60 paisa are different. Do not get confused with the difference between your opening and closing NAV. So therefore, what is that we should consider as income? So we should consider 85 paisa as a part of income, 60 paisa also as our income, and the difference between the opening and the closing, that is also an appreciation, that will also be taken up as our income. So all these three factors divided by the initial investment that you have made, that being 9 rupees and 75 paisa. So the total income divided by 9 rupees and 75 paisa, and the time horizon is for 1 year, and 12 divided by 12 is going to be 1, multiply it by 100, whatever percentage that you get, that is going to be the annual yield. So here is a place, how many number of units he is holding, given in the problem as 1000 or 500 or 10,000. So whatever may be the number, the percentage what you are going to get will not have any change at all. Whether you sell 1 unit or 10 units at the same price and at the same cost of goods sold, you will not have a different gross profit rate. Gross profit rate will remain the same. Whether you are having single unit sold or 10,000 units sold, when you adopt the same selling price and the cost for all the units. So therefore, that piece of information given as 1000 units that he had bought is redundant. If at all you want to use that, so multiply that by that many number of units that you have bought. So much will be the income. So that many number of units multiplied by 9.75 is going to be a denominator factor. So by doing that operation, you yourself will agree that the 1000 information, that 1000 units what they have bought is not that much relevant. But at the same time, we will just put a note saying that we will simply ignore that piece of information, will not be having any utility value at all. This is option number 1 that we have seen. What is that they have given in option number 2? They have said these distributions are to be reinvested at an average NAV of 9 rupees and 75 paisa. What is this? So sometimes what will happen is that the money upon distribution to unit holders and once again collecting it from them would involve some transaction cost, entry load will be there. So these unit holders will be informed by the portfolio managers and by the mutual fund itself that such an amount of money need not be distributed, and instead the money will be plowed back once again into investments in equity shares and debentures. So this is what we call it out as plowing back. And what would happen? Definitely the unit holders will be deprived of the money. What is that the mutual fund would do is that in lieu of that, instead of providing the cash dividend, they will be substituting, they will be replacing in the form of cash dividend some additional units to be given to unit holders. So if they were to be provided with say 100 rupees in distribution, where you find 5 rupees as NAV, so instead of giving 100 rupees, you give them in the form of kind, that being 20 units. This is what we call it out as reinvestment plan. So that reinvestment plan will enable the unit holders to get greater amount of units that of course they can encash by selling it off in the market. So instead of collecting it cash in the form of dividend and capital gains, when they collect it in the form of additional units, the additional units can be sold and they can encash. What is the problem for the investor? So there is no problem at all. But between the first option and the second option, which one is better is the question that they asked. On what basis we have got to tell. So now we will work out for the second option, because so orally we can't be just bringing out too much of computations and calculations. Let us just put them in black and white and let us put it in Windows Journal, and through Windows Journal we will be in a position to understand this solution much better. Now we will just switch our attention to Windows Journal. It is on question number 4. Now let us just take up option number 1 firstly. We all know that rate of return for equity shareholders, or in this case unit holders, could be income plus, dividend plus P1 minus P0 divided by P0 into 12 divided by N into 100. This is a general formula. Under dividend, we are receiving in this particular case 85 paisa, and capital gains also distributed 60 paisa plus 10 rupees and 35 paisa minus 9 rupees and 75 paisa. Let us deduct that and divide it by 9.75 into 12 divided by 12 into 100. Now let us take the calculator and cross verify. It is 0.85 plus 1.2 divided by 9.75 in percentage, that comes to 21.03 percentage. 21.03 percentage is what you are just getting, right? So this we have adequately explained. This dividend, this capital gain is different from that of the difference between P1 and P0. Now let us just take up the second alternative, that is very, very important. That is dividend reinvestment plan. Dividend reinvestment plan. That means cash dividend is not paid in the form of cash dividend. In lieu of that, additional units were provided. How is that? We have to take it up. Cash dividend of 85 paisa, then capital gain cash 0.60, 1.45 not paid in the form of cash. So what is the NAV? NAV is 9.75. Additional units would mean 1.45 divided by 9.75. So one and only if the item is 9.75, you can make it up as 1 unit. When it is only 1 rupee and 45 paisa, how much is that? 1 rupee and 45 paisa to 9.75. So 1.45 divided by 9.75, it gives you 0.1487, which you would round it off to 0.15 units, because only with 2 decimals you can have this adjustment carried out. Correct. So now let us just know how to find out rate of return. Rate of return for in the second option, as how it will be worked out, is 1.15 units you will be having that you can sell at 10 rupees and 35 paisa minus only 1 unit on which you have subscribed at the rate of 9 rupees and 75 paisa, the whole divided by 9 rupees and 75 paisa into 12 divided by 12 into 100. Are you understanding? from where you are just getting that 1.15, 1 unit that you have already made as investment plus 15 additional units you have got on account of dividend reinvestment into 10.35 the closing or exit NAV we have just provided with one that you have bought at 9.75. Now let us just bring out the difference. 1.15 into 10.35 minus 9.75 divided by 9.75 into 100, that should give you the number as 22.08%. So one can take decision not based on absolute numbers but based on percentages, yield in percentage. So you understand in the first option you get 21.03, second one you got it out as 22.08. What is that? 21.03 in the first case, and the second case it is 22.08. Which one is better? Definitely the second option is giving you 1% more. Therefore, option number 2 is a better choice than option number 1. Okay, now let us proceed to question number 5. So, question number 5 is a question on which we will be finding out how NAV will normally be computed. It's a very basic, or you can call it as a rudimentary problem. Mark this problem as very important. So, this is the first stage of learning as how NAV will be computed. So, there are 4 companies in which they are bringing out an investment. So, let me just formally read. Following is the content of an open-end scheme of a mutual fund which contains 15,000 units as day number 1, company, number of shares and day price. So, JKL 10,000, 2,000 and 4,500, 49.93, 38.23 and 44.07. Calculate day 1's NAV. Supposing 1000 additional units were purchased by investor by day 2 at day 1's NAV and the portfolio manager utilizes entirely for L Limited, find out NAV of day 2 if JK and L are 51.23, 40.93 and 45.97. There is no load in the above scheme. Now, let us just know about how we proceed. So, in the sense, firstly let us find out the first day's NAV. So, this problem did not carry any information whatsoever regarding other item of assets, liabilities, even cash balance, etc. So, assuming that you do not have any other item excepting these investments and at these prices. So, what we are expected to do is that multiply simply the number of shares and the day price, arrive at the investment value, and when they have not mentioned any liability, liability will be taken up as 0. So, these values are to be divided by 15,000. That should give you the NAV for day number 1. And at this particular price, you find 1000 units for which they have subscribed. Next day, money is just flowing into the stream. 1000 into NAV of the first day is going to be the inflow. So, with that inflow, with no entry load nor exit load, the entire amount is available for investment. The portfolio manager can invest either in J or in K or in L or any other investments outside this particular portfolio. But in this problem, very clearly they have mentioned that portfolio manager will invest in shares of company L. That is what they mentioned, but they have not mentioned at what price. When no mention is made regarding the price, we can take up a price of the last day. The last day's price of L is 44.07. With so much of money had just come, divide that by 44.07 so that you can find out the number of shares that you have bought of L. The next day's NAV when you are computing, 10,000 will remain at 10,000, 2,000 will be remaining at 2,000, whereas 4,500 will not be remaining at 4,500, that will be 4,500 plus additional units that we have bought. And then day price whatever you are having, that will be taken up from the bottom line and multiply that, arrive at the total value of assets. There is no liabilities and that shall be divided not by 15,000 but by 16,000, 1 6. Why 16,000? We have to take up the first day we had 15,000 additionally 1000 units we are getting into the stream. So total outstanding units by day number 2 end will be 16,000. So much of value of assets minus liabilities shall be divided by 16,000 units and not 15,000 units. So please be careful, and it should not be taken into consideration the number of shares. Number of shares that we have bought in L will automatically be taken care of in your numerator, and thereafter we should not be using it, and the total net asset value shall be divided by the number of units by then, that being 16,000. By doing so, you can arrive at the NAV of day number 2. It's a very simple problem, but let us develop that practice of solving even that simple problem and convince ourselves that further complicated problems can easily be handled. Now let us just try through Windows Journal the solution to question number 5. Now let us just take up the first part of the solution, that being finding out NAV for day number 1. So companies are J, K and L. Number of equity shares are 10,000, 2,000 and 4,500, and prices are 49.93, 38.23, 44.07. What is that we are expected to do? Multiply these two, arrive at the value of assets. What is that then we should do? So 10,000 into 49.93, 4,99,300, 2,000 into 38.23, 76,460, 4,500 into 44.07, 1,98,315. Sum of all that comes to 7,74,075. 7,74,075 is the net asset value. Per unit basis we want. NAV of day number 1 is 774,075 divided by 15,000, which is equal to rupees 51.61. Rupees 51.61. This is the NAV for day number 1. Now what they have mentioned is that 1000 additional units were purchased by investors at day number 1 NAV. So day 2 computation, inflow of money is going to be 51.61 into 1000, that is equal to 51,610, correct? So NAV of, not NAV, day 1 price of L, which is equal to 44.07. This they have not mentioned, but we are assumed. For the sake of convenience, $51,610 divided by 44.07, which is equal to 1,171 shares. Here you can't take up 2 decimals, you have got to round it off. Number of additional shares of L. Now let us just know as how day number 2 NAV shall be computed. So company J, K and L. Numbers are 10,000, 2,000 and 671. How come? 4,500 that they are given in the problem plus 1,171, correct? Then the prices what they were given as
51.23, 40.93 and 45.97. Now let us arrive at the value. So what is the value that we should arrive at? 10,000 into 51.23, 5,12,300, 2,000 into 40.93, 81,860, 5,671 multiplied by 45.97, 2,60,696. Memory recall, I think here is 8,54,856. Let us just check up independently. 512,300 plus 81,860 plus 2,60,696, all put together that comes to 8,54,856. Then number of units will be 16,000. 15,000 which already existed plus 1,000 additionally bought by investors. So NAV for day 2 is going to be 8,54,856 divided by 16,000 units. That should give you 53.43. So please just understand that we have just answered to that question. What sort of question? Find out NAV for day number 2 is what they have asked. And when you have these many details and with no load, indicate that either at the stage of entry or at the stage of exit. So this is the way NAV can be arrived at. So though it is a very simple problem, I feel like that it is the first problem. Then when you are working out, it will stay very long in your memory, and it could also be a very simple question under examination conditions. Mark this particular problem as very, very important before we could proceed for the next problem. And rest of the discussion and the next units we will be taking up in the next section. Thank you.